In this video, we're going to talk about 8 safe stocks that pay monthly dividends that you should consider adding to your investment portfolio. So, before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. In the midst of the recent market downturn, the best safe monthly dividend stocks are surprisingly alluring. However, over the past few months, the value of many top dividend stocks has also significantly declined. The pullback offers a fantastic chance to buy dividend stocks in large quantities and establish a reliable income stream. Typically, companies with dividend stocks have strong dependable earnings that can be reinvested for the benefit of their shareholders. It can significantly lessen investors' losses during the current bear run. Investors look for stocks to safeguard their portfolios during economic downturns. In essence, holding onto these stocks pays investors, and investors may reinvest their earnings to accelerate portfolio growth. Having said that, let's take a look at 7 of the top dividend stocks you should consider buying. Number 8. Stag Industrial, ticker, STAG. Realty income was pretty darn close to Amazon.com proof. But fellow monthly payer Stag Industrial proactively benefits from the rise of internet commerce. Stag invests in logistics and light industrial properties. You know those gritty warehouse properties you might see near the airport with 18-wheelers constantly coming and going? That's exactly the kind of property that Stag Industrial buys and holds. It's a foregone conclusion that e-commerce is growing by leaps and bounds, and Stag is positioned to profit from it. Approximately 40% of Stag Industrial's portfolio handles e-commerce fulfillment or other activity, and Amazon.com is its largest tenant. E-commerce spiked during the pandemic for obvious reasons. As stores have reopened, the effects of that spike have dissipated somewhat, but the trend here is clear. Consumers are making a larger percentage of their purchases online, and that trend only goes in one direction, which is up. Yet there's still plenty of room for growth. As crazy as this might sound, fewer than 14% of retail sales are made online according to the U.S. Census Bureau. Furthermore, the logistical space is highly fragmented, and Stag's management estimates the value of their market to be around $1 trillion. In other words, it's unlikely Stag will be running out of opportunities anytime soon. Stag Industrial isn't sexy. But it's one of the best monthly dividend stocks to buy in 2022, with a long road of growth in front of it. And its 4% plus yield is competitive in this market. Stag Industrial's dividend yield is 4.2%. Number 7. EPR Properties, ticker, EPR. EPR Properties, formerly Entertainment Properties Trust, is a real estate investment trust, or REIT based in Kansas City, Missouri, that invests in amusement parks, movie theaters, ski resorts, and other entertainment properties. It owns 353 properties as of 2022. EPR Properties has recently seen its stock dip due to rising interest rates. However, another major issue for the net lease real estate investment trust is that one of its largest tenants, Cineworld, filed for bankruptcy. However, the REIT has a healthy cushion to maintain its strong dividend numbers. After paying its dividends, it expects to generate an incredible $150 million in excess cash. Moreover, it operates an investment-grade balance sheet with plenty of liquidity, including $1 billion in an undrawn credit facility. In expanding its portfolio, it will be looking to invest $500 million to $700 million in acquiring new real estate this year. Those deals are likely to help diversify its exposure to the theater sector, helping improve the long-term sustainability of its dividend. EPR Properties' dividend yield is 8.2%. Number 6. Gilead Sciences, ticker, GILD. Gilead Sciences is one of the leading biotechnology companies with a market cap of over $70 billion. It's been growing sales at a healthy pace each quarter and recently wrapped up a reasonably successful second quarter. Product revenues outside of its C-19 virus-focused drugs rose 7% from the prior year period, amounting to annualized sales of $23 billion. Its investments in new businesses are paying off, with oncology sales up by more than 71% for the quarter. Gilead also increased its guidance for the quarter despite a few setbacks as it continues to execute on its pipeline and driving returns. Also, it has several exciting catalysts, with a wide portfolio of oncology drugs entering phase 2 and 3 trials. With more than $6 billion in cash, it remains in a strong position to maintain its dividend payouts for the foreseeable future. Gilead Sciences' dividend yield is 4.65%. Number 5. Chevron, ticker, CVX. Chevron is the second largest integrated oil and gas company in the US. It has been one of the most reliable income stocks thanks to its robust dividend scorecard. It raised its dividend payouts for 35 straight years, making it a dividend aristocrat. Though dividend growth isn't too high, its yield more than makes up for it. Moreover, it implies an incredible 7% shareholder distribution. Given its massive capital expenditure plans, it's likely to do much better than $40 billion in cash flows. Chevron's dividend yield is 3.92%. Number 4. San Juan Basin Royalty Trust, ticker, SJT. San Juan Basin Royalty Trust is a Texas-based express trust that owns interests in various oil and gas properties in the San Juan Basin of New Mexico. It pays out higher royalties when oil and gas prices are up, as they have been of late. Consequently, its revenue growth on a year-over-year basis is 171.5%, comfortably ahead of its 5-year average of 47%. Its stock sold off earlier in the year amidst a strong pullback in U.S. natural gas prices after the Freeport LNG explosion. Once export capacity improves, natural gas prices will trend northward, thanks to rising European demand for securing non-Russian gas supply. San Juan Basin Royalty Trust's dividend yield is 15.16%. Number 3. Intel, ticker, INTC. Semiconductor stocks emerged as winners during the pandemic, but one of the biggest players in the niche, Intel, couldn't reap most of those gains. Consequently, it trades at just 1.7 times forward sales, more than 44% lower than its 5-year average. Current market headwinds have affected recent results from Intel, but its focus is more on its future, where it aims to revolutionize semiconductor manufacturing. It plans to spend a whopping $55.5 billion in capital expenditures on developing foundry fabrication plants, or fabs. It aims to become the main resource for fabricating chips to order, representing the next era of semiconductor manufacturing. Moreover, the company is likely to be the biggest beneficiary of the U.S. government's CHIPS Act, which could have it see $10 billion to $15 billion worth of subsidies in the next 5 years. Intel's dividend yield is 5.3%. Number 2. Dow, ticker, DOW. Dow is among the 3 largest chemical companies worldwide, with annualized net sales of over $50 billion. It's one of the most consistent businesses in its niche, generating 11% sales growth on average over the past 5 years. Its current net sales exceed $50 billion, and it's maintaining its annual EBITDA target of over $9 billion. Dow boasts several competitive strengths over its peers, including its extensive low-cost feedstock positions, massive scale, high-quality manufacturing, and market reach. Consequently, it has built a cash war chest, which includes $2.4 billion in cash equivalents and $12.2 billion in available liquidity. In the past 6 months, it generated a remarkable $2.7 billion in free cash flows, taking its levered cash flow margin to almost double digits. Hence, its rock-solid liquidity positioning is in a strong position to maintain its dividend portfolio for the foreseeable future. Dow's dividend yield is 6.38%. Number 1. LTC Properties, ticker, LTC. LTC Properties is a REIT specializing in senior housing communities and skilled nursing centers. Its operating results have fluctuated over the past several quarters, but of late, it's been posting some strong numbers. It is likely to benefit from the secular trend of an aging population in the US, which bodes incredibly well for its long-term positioning. Its second quarter results were solid, with it beating revenue and EPS estimates by 11.7% and 9%, respectively. Moreover, total sales of $43 million topped consensus estimates of $37.9 million and $38.1 million from the same quarter last year. Rental income came in at $31.6 million compared to $30.3 million in the prior year quarter. Moreover, total expenses rose by a mere 5.5% due to cost efficiencies and lower depreciation charges. On top of that, it reported a hefty $38 million gain from real estate sales. Therefore, LTC remains in a strong position to continue capitalizing on senior housing and skilled nursing properties by expanding its margins. LTC Properties' dividend yield is 5.92%. These safe monthly dividend stocks come with industry-leading dividend yields that offer an effective hedge against inflation. While most dividend stocks make their payouts on a quarterly basis, stocks that pay monthly dividends can be particularly appealing to investors who regularly incorporate those dividends into their household budgets. Stock prices can be unpredictable, but dividend payments from high-quality companies are reliable sources of cash flow no matter if the stock market goes up or down. Dividend stocks can also generate long-term upside for investors. Which of these safe dividend monthly paying stocks would you consider adding to your investment portfolio? Let us know in the comments below. And don't forget to like this video and subscribe to our channel for the best stocks to buy and the latest investment strategies for building wealth. Thank you for watching.